a working population which is growing in the standards of living, thereby creating an inherent consumer market. To add to that, during this pandemic and because of the events subsequent to that, we are seeing a shift of manufacturing base from various locations in the eastern part of the globe and moving into other jurisdiction. Indian government has been working hard to ensure a very conducive environment to invite those investments into India. And we have seen that a number of state and federal incentives are being offered, and we'll touch upon some of those. In fact, the Indian government has, with the view to ensure that they are bringing in large investments into the country and especially into the manufacturing sector, also brought in effective corporate rate reductions. Just to touch upon a couple of them, uh, would be the corporate tax rate has been brought down. As we move to the next slide, the corporate tax rate has been brought down in case of new manufacturing locations to be set up in the country to as low as 15%, which I should tell you is one of the lowest rates among countries in this jurisdiction, in the region. In fact, for existing domestic companies also, and when I say domestic companies, it includes subsidiaries of foreign companies as well, there is a lower rate of 22%, subject to certain conditions as it applies. Also, the normal rate has been brought down to 25%. So all in all, as we see that the country has been offering a conducive corporate tax rate with a view to ensure that it becomes an effective investment destination. Uh, just to add one more point, and effectively is that the new rate of 15%, while being available to new investment opportunities or new manufacturing companies or new manufacturing locations being set up in the country, there are structures by which even an expansion or the creation of a new line can be structured in a manner that you can be eligible to avail this low rate of 15%, even for those bunch of operations, without again uh, being affected by the anti-abuse provisions. Moving on, even the state governments and the central government have been announcing various incentives. For example, the government has come out with a product linked incentive, which is a subsidy sort of to the range of 4 to 6% on incremental sales. So far, it has announced already for certain electronic items such as mobile phones, but in the queue are medical devices, pharma, for various aspects of the pharma industry like drugs, APIs. A lot of electronic consumer products also are in the pipeline for being offered this benefit. We have the scheme for promotion of electronics and components and semiconductors, which is enjoying a certain benefit that if you're putting up a unit, you will be subsidized to the tune of 25% of the capex, subject of course to certain terms and conditions, and this subsidy being paid across back to you over a period of time while you're in operation. There is also the cluster scheme which the government has announced, which facilitates setting up of electronic manufacturing corridors into certain areas, which of course is governed, and it also provides for a financing facilitation if you are setting up a unit in the cluster scheme. Net, all I'm trying to say is that not is the legislative and the regulatory environment in the country undergoing change. The government is taking proactive steps to ensure that India becomes an attractive destination. Not to forget, India has always and continues to endeavor to neutralize every tax burden on export of goods and services. So exports taking place from India are also facilitated by various schemes provided under the foreign trade policy. Having said this, what we are coming to is that India is becoming an effective investment destination. The important point is that if the investments are coming into India and if these are foreign investments coming from other parts of the world, uh, there is always a concern, and specifically concerns on two parts, as to the protection of that investment and the efficiency of getting the returns on that investment, as well as the gains that you can get on exit. And when I say efficiency, so first, when I say protection, of course, we had the bilateral investment protection agreement, the BIPA, which has been famous also in the recent Vodafone arbitral award, which was issued. Of course, the BIPA now has been discontinued, but that's from a protection angle. The other significant aspect which comes in is the efficiency from a tax perspective. And therefore, you have the double tax avoidance agreements that India has signed them with a host of almost more than 100 countries. And those determine the taxing rights of the jurisdictions, of course, the investing jurisdiction and the jurisdiction where the investments are made. Typically, the two aspects which become critical are the return, the repatriation of the returns or the profits from the operations conducted or the investments made, and finally the exit through the gains on exit. If the tax burden is turning out to be pretty heavy, it will result into a reduction of the investment, and therefore it's important that when you are taking an investment decision, the same is evaluated and analyzed from the perspective of how it should be structured so as to make it efficient. Traditionally, investments into India had been rooted through Mauritius or Singapore, because Mauritius continue to offer an exemption on the, or rather the gains arising on exit were taxable only in Mauritius with a lower rate as existing in Mauritius. In case of Singapore, also you had the same provisions. However, both these treaties have been amended because coincidentally the Indian government apprehended that the Mauritian, the Singapore or the Cyprus treaties were being misused and resulted into evasion of tax. And therefore, the result that we have is that these treaties have been amended by which this benefit which was being available to investments being brought into the country have now no more existing. At this point in time, it's important, and that's why we are doing this presentation, is what is the other alternate route that you have, and that's the India Netherlands double tax avoidance agreement. Let us just touch upon certain features of this agreement and why and how do we say that it is beneficial. First of all, from a capital gains perspective, there is a beneficial capital gains provision under the India Netherlands Treaty by which the gains arising on transfer of shares other than quoted shares in an Indian entity when transferred to a non-resident will be subject to capital gains only in Netherlands. It is not subjected to Indian capital gains. Second, in case of dividends, as we are all aware, the dividend traditionally, India had the dividend distribution tax, which at the start of this year has been abolished, and now we are under the traditional dividend tax. Dividend tax again, under the MFN, which is part of the protocol of the India Netherlands Treaty, is subject to a lower tax. And let me explain how. The protocol to the India Netherlands Treaty says that in case where a third state, which is a member state of the OECD, should limit its taxation at source on dividend, and it goes to various others, interest, royalties, etc., to a percentage or a scope lower than that under the India Netherlands Treaty, then such lower rate would become applicable. Now, we have the India Slovenia Treaty, which was signed on the 17th of February 2005, which offered a 5% rate. Slovenia thereafter went ahead to become an OECD country on the 21st of July 2010. Accumulation of all of these events can justify to say that dividends repatriated by an through an Indian investment back to a Dutch holding company should be taxable at 5%. In fact, the State Secretary of Finance of Netherlands has issued a decree ratifying this aspect, as I mentioned, under the in relation to the taxability at 5%. This has, of course, not been tested in India. A question somebody may raise and a concern could be raised is whether, when it says a third state, which is a member state of OECD, should limit its taxation, the question may arise that should the member state should have been existing at the time when this protocol was in existence, or could it be a later on member state also, or whether the member state with whom the DTAA was signed should have been a member state at that point in time. Because as we see in the case of Slovenia, when the DTAA was signed, it was not a member state. It became a member state later on. So could someone question that this would therefore not qualify and would not be eligible for 5%? Uh, it is an issue of concern, but I don't think that hopes can be dropped to extent that the 5% rate would not be available. there are alternatives that we have in India through the filing of an authority for advanced ruling application and getting a ruling for a certainty on this issue. So, both from the dividend perspective, which is your gains, which is your repatriation of profits, the India-Dutch treaty makes it lucrative. Also, from the gains on exit, it becomes quite effective. Uh, Not to forget that what we see in the protocol, the other sources of income, and there could be multiple sources of income, and these become a significant portion of the analysis when you are determining the investment into a country, either routed through Netherlands or directly from Netherlands, because there could be income flowing in the form of interest, fees for technical services, royalties, etc. And therefore there will be a need to analyze what would be the tax cost of each of these streams of investment, including the tax on the gains arising on exit. This analysis becomes very critical, and now to consider investments through and in light of the India Dutch DTAA is also a very important aspect. Two more aspects on the India Dutch treaty, and I will request my co-speaker Everjan from Taxand Netherlands to give us throw some more light on this. But the Dutch jurisdiction also provides for participation exemption, by which the capital gains and the dividends from the Indian company enjoy some sort of an exemption benefit because of the holding subsidiary structure under which this repatriation of profits or dividends and the gains are arising. Lastly, I will also request Everjan to throw some light on the broad dividend withholding tax exemptions available for shareholders in the Dutch holding company. So, where you're using the Dutch holding company as a routing entity uh, for investments coming from another third jurisdiction, the dividends repatriated by the Dutch holding company to these jurisdictions would also be enjoying some sort of, are also facilitated with some sort of beneficial provisions in Netherlands, and we'll understand that as well. Lastly, not to forget, all of these structures, the most efficient and effective structures, will need to be sustained. And the biggest question of sustainability in today's time and age is the existence or the satisfaction of substantial, is the requirement for substantial requirements, the substance requirement that you have enough substance in the holding company, the entity that you're creating in Netherlands. And we will have a few slides later as we go in the presentation where Everjan and my colleague Rahul will take us through the substance requirement, as well as some of the anti-abuse, the GAAR provisions, which have been existing in both these jurisdictions. With that, may I request Everjan to take us through from the Netherlands perspective for the benefit of the audience.
Yeah,
Everjan.
thanks, Nishant. And indeed, what as some of you may know, the Netherlands has been around quite some years, facilitating global investors in setting up European holding platforms. This all goes back to basically the previous slide on the existence of a super attractive fiscal climate for holding companies. So, as Nishant explained, on the one hand, for when foreign investors set up a Dutch entity to invest in India, as the example shows, it is of course crucial that the Dutch holding company does not attract additional leakage compared to an investment by the, in this case, red box directly into the Indian company. So the Dutch holding regime provides for two things in this respect. On the lower end, it provides an attractive exemption regime, which we call the participation exemption regime, which basically exempts from Dutch tax any income derived from the shares in the Indian company. And with income, hey, you should think of dividends and capital gains income. And on the top end, so when the holding company wants to distribute the receipts from the Indian company to its shareholder, the red box, there for that where most countries levy a withholding tax on dividend distributions. The Netherlands also levy such a dividend withholding tax, but the Dutch dividend withholding tax regime comes with ample provisions to exempt that withholding tax. Explicitly, where the shareholder, the red box, is resident in an EU state, or even outside the EU, where the shareholder of the Dutch entity is resident in a state that has concluded a double tax treaty with the Netherlands, which is basically given the fact that the Netherlands have a very wide treaty network, basically includes many investment jurisdictions. Of course, as Nishant referred to, the Dutch holding company could also incur other types of income. For that, the Dutch holding regime also avails of tax planning techniques and also a relatively low corporate tax rate to also be an attractive location to set up your holding company. Yeah, and that goes a little bit back to the Dutch advantage. When you look at Europe and when you want to set up your holding company somewhere in Europe, I think it is good to consider the Netherlands' advantage. There are some obvious points. As some of you will know, we have been around for quite some decades in the international field, being a small country. So we have superior technology. We have a very investment and investor-friendly climate. Given the fact that as a small country, we are dependent for our economy of foreign investors, foreign investments. Against that background, the Netherlands has been concluding tax treaties as of early last century, which currently means that we have approximately 90 tax treaties in force. One of the other key elements to keep in mind when considering your European jurisdiction and when considering the Netherlands is that the Netherlands tax authorities have a certain tax ruling practice, and that means that if foreign investors can get upfront certainty on their Dutch tax position by basically concluding an agreement in this respect with the tax authorities, have an open discussion with it, but also come to an agreement in the form of so-called advanced tax rulings, which basically confirm, which is nothing to hide, but it is just a confirmation of the tax treatment that a certain Dutch holding company will get. For instance, confirmation on the application of the participation exemption, and for instance, confirmation on the availability of the withholding tax exemption. Well, apart from these benefits, there are some other tax incentives. For instance, an innovation box to attract IP and IP companies. We have a well-educated and multilingual workforce and a strategic location. But I think looking at all these advantages and also looking to the main competitor in Europe, which tends to be Luxembourg, I think the combination of the strong investment climate, the strong climate, the good climate to live in light of the substance requirements, where we will discuss on later, all in combination with the tax ruling practice, that are key advantages of the Netherlands. And then I would like to ask Berend we have now been discussing the Netherlands from a perspective as an inbound into India. But Berend, can you reflect on the Netherlands as the other way around, as an alternative for an outbound structure?
Yeah, thank you, Evert-Jan. Of course, the Netherlands can also be used as a interposing entity, and With this slide, we want to show that interposing a Dutch holdco allows for several tax opportunities if structured correctly. So in the slide, we see an Indian company on top, an interposed Dutch holding company, which in turn holds the shares in an EU or non-EU company. And let's talk through this corporate structure to see where the advantages are. First of all, the treaty, as already mentioned by Nishant and also Evert-Jan, between the Netherlands and India provides for competitive withholding tax rates. And also there is a domestic withholding tax exemption for dividends that are paid by the Dutch holdco to India. This dividend withholding tax exemption has some conditions to be met, but over the years has become more and more relaxed. And as already mentioned before, since India and Netherlands have concluded a treaty, it is very well possible to make use of the dividend withholding tax exemption at the level of the Dutch holdco. Furthermore, as also mentioned briefly by Evert-Jan, there is a very established tax ruling practice in the Netherlands, and the Dutch tax authorities are very open for discussions on your tax matters. Of course, we have a good relationship with the DTA and also have ample experience with the ruling process. And this is really something that for the Netherlands stands out, especially in Europe. As a lot of other European countries, the tax authorities are very strict and are not open for discussion. So this is really an advantage of using the Netherlands as an interposing entity. For example, there is the possibility to have the participation exemption ruling for the shares held in the EU non-EU company, as you can see in the slides, the red box. And also there is the possibility to rule the exemption from the Dutch company to the Indian company. And at the bottom of the slide, we see also the extensive treaty network of the Netherlands. There are more than 90 tax treaties worldwide, which really opens up investment opportunities worldwide from a Dutch perspective. And concluding these 4 bullets, it is possible, if structured properly, to receive dividends and capital gains from the EU non-EU company tax-free into the Dutch holding company, which can then be further dividended up to the Indian company, also tax-free from a Dutch perspective. So in this corporate structure, there is no tax leakage whatsoever, and this really provides for an interesting opportunity. And now I wish to continue with the slides from a substance requirement perspective, also already briefly touched upon by Nishant and by Evert-Jan. This is a really important item to be reviewed. So the floor is yours.
So if you look at the next slide, the Dutch substance requirement. I think it's good. Thanks, Berend. We discussed. We won't go through each and every detail of these Dutch substance requirements, but it is good to see, as Nishant mentioned at the beginning of this conversation, that the times that you could simply set up a Dutch holding company and also benefit from the tax benefits that Berend referred to, the treaty network, the participation exemption, is basically only no longer possible without having proper Dutch substance. The same goes actually for being able to benefit from the Dutch ruling practice. Also, that does require nowadays to have that the company that you set up has sufficient Dutch substance. So, and then is the question, what is it then, Dutch substance? Well, if you look at it's covered on 2 slides. the topics that you see on the previous slide are the typical ones, the substance requirements which you tend to see for other companies in internet in many countries. So having local directors, having board decisions in the Netherlands, a local bank account, bookkeeping being done in the Netherlands. But the next slide, that's where things become interesting. Given in light of recent developments, the Netherlands have been focusing more and more on facilitating Dutch holding companies only if they have sufficient substance. And what is and meaningful substance, basically? And what is meaningful substance? That is a difficult area. It's a gray area, but in light of recent developments here in Europe, we have had some interpretation given by the Dutch government. And what you see nowadays is that it does require the Dutch holding company to have a real nexus. So apart from the standard requirements, it tends to be necessary to have at least a certain amount of payroll costs in the Netherlands, to have a certain office space rental being able to rent in the Netherlands. That's become critical, not only for the Dutch holding company to work, participation exemption, access to the ruling team, but also the same Dutch substance requirements should also be met by the shareholder to benefit from the Dutch withholding tax exemption. If the Dutch said, so let's go back to the previous example. Let's assume you have a US investor seeking an investment opportunity in India, setting up a Dutch intermediate holding company. That's all good to go from a Dutch holding perspective, but you do need to set up and maintain a certain amount of substance in the Netherlands to make sure that you get access to all the facilities in the Netherlands, the tax facilities, but also in order to make sure that the Dutch withholding tax exemption is available on future distributions from the Netherlands to the US. The US shareholder should have also similar payroll requirements and office space requirements to be met at its own level. And Nishant, Rahul, can you reflect, I think, on the next slides on the Indian perspective of all this?
Yeah, absolutely, and I'll request Rahul to just throw some light on. But I completely agree to the points that you made. That some time back it was possible to just set up a holding company, but with these new provisions coming in, it's very important that we are able to meet with the substance requirement. Rahul, can you throw some light on the GAAR provisions in India and how do these interplay and where do we need to be careful about?
Sure. Thanks, Nishant. Thanks, Avajan. Thanks, Piran. So while we have looked at the advantages of having the Dutch intermediate holding company, and of course we've also dwelled upon how the requirement of substance within the Netherlands is important. Let me say that it is not just important only from a Dutch tax perspective, but also from an Indian perspective. We recently have enacted the general anti-avoidance rules, which empower, or which is a great tool available in the hands of the tax officer to look at the transaction in its real sense and apply the provisions of tax laws accordingly. Now, what is, and just if I can give you an overview of what these GAAR or the general anti-avoidance rules are, uh, it, it foremost requires an arrangement. Now, what is an arrangement? It is of wide import. Anything that is structured in a particular way can fall into the definition of arrangement. The second requirement for GAAR provisions to trigger is that the main purpose of this arrangement should be a tax benefit. Again, there's a lot of subjectivity to what is a main purpose, whether there can only be one main purpose or there could be multiple main purposes. Uh, but that is again a matter of factual evaluation. But if that has to be just went for, or it's just gone further into the provisions to say that an arrangement apart from having a main purpose of a tax benefit should also have one of the four elements or the tainted elements, if I may state, to say that the arrangement should be such that it would not have been the way it is had it been a transaction entered into between parties dealing at arm's length, right? So it's again bringing in a third party behavior where two independent parties would not have agreed in a particular manner, the way in which the agreement or the arrangement has been placed. uh, the second bit is, if it entails an abuse, whether directly or indirectly, of any of the tax provisions. Now, again, what constitutes abuse and the whole issue of tax planning versus tax evasion comes to light here. The third and the most important, or by far the most critical condition being that it lacks commercial substance. So if the arrangement is such that it lacks commercial substance, then the GAAR provisions can be triggered so as to undo the transaction or the arrangement in which it has been so arranged. And the fourth is that it is not done for a bona fide purpose. Uh, as I mentioned, the third bit being the commercial substance as one of the critical condition. It is also important because the provisions of the Act also give an indication of what could be said to be lacking commercial substance or deemed to be lacking commercial substance. And one of the point there, and if it has to be read and interpreted in the context of an IHC structure that we discussed at the beginning, is that if it involves a place of residence, okay, any part, any party, so any party has a place of residence which is without any substantial commercial purpose. Now, how do we really interpret this in light of the structure which Nishant, or for that matter, Evergen and Brent took us through? So an Indian entity investing into a Netherlands entity and the Netherlands entity further investing into, let's say, any other jurisdiction into Europe. Now, this Netherlands entity, if the main purpose is just to gain a tax benefit, right, and this Netherlands entity lacks commercial substance, then the GAAR provisions are triggered, which means to say the consequence of which would be that the India Netherlands tax treaty benefit would not be available. Now, in light of this, let's look at some of the things or some of the arguments which we can really pose at this moment, while it's very difficult to generalize the arguments as the anti-avoidance may be general, but specific fact patterns may have some specific commercial backings for any uh, IHC or having Netherlands as a jurisdiction. uh, some of the key points mentioned by Evergen was the advantage that Netherlands brings in. It's a small country, but it has a very conducive business environment. The technology, I think, arguably is the best in class uh, within the Europe continent, so as to giving it an advantage to have a hub in Netherlands for a technological advent. uh, a stable economy with low inflation. The workforce in Netherlands also obviously plays a big role. The workforce policies or the employment policies there are very flexible. The workforce is motivated. They're also very highly educated. Apart from educated, I think they're also very skilled in their domains, and that could be one strong commercial reason for having a intermediate holding company in Netherlands, uh, which could also work as a defense for invoking the GAAR provisions. You see, if you look at some specifics, you'd see a lot of distribution entities within the Netherlands. The reason also is because of the distribution know-how which resides within the Netherlands, and that can be one strong defense again for having Netherlands as an intermediate holding company jurisdictions. The cost of operations, again, having a big commercial role to play in a decision making for investments. So that obviously stands good apart from the high quality of financial and business service sector there. The last point which one can really look at from a Netherlands or and having an IHC in Netherlands is I think the IP and the IP protection laws there. So Evergen did mention about Netherlands offering a beneficial corporate tax regime or a innovation box regime there in the Netherlands. But so that also is backed with a lot of IP protection which Netherlands offers as a jurisdiction, encouraging companies to set up IP hubs within the Netherlands. Uh, so these are a few points, and we'll just circle back to the tax in Netherlands friends. If there are any other commercial substance which they feel could add to the arguments for keeping the GAAR provisions away from investing into India via the Netherlands or vice versa. But just before we touch base on that again, not to forget the MLI being kicked in since we are on anti-abuse provisions. The India-Netherlands Treaty has been a part of the covered tax agreement both for India and for Netherlands. And the way in which the treaty would look post the synthesized text being out is that we would have a principal purpose test being made applicable to the current India-Netherlands Treaty. The principal purpose test, of course, requires that the principal purpose not being to avoid taxes. And well, it's only for time to tell that how this clause plays in and how that is interpreted. But again, getting back to the whole argument to defend this or the PPT or the GAAR provisions would be substance and the commercial substance. Before we kind of hear from our friends in Netherlands of about a few other commercial aspects there or the MLI perspective from or the MLI from a Netherlands perspective. One important factor is also that Netherlands as a jurisdiction has its own substance requirements as Evgen took us through. You see, now that also plays a big role. I would like to highlight one Bombay High Court ruling of Universal International BV, which was in the context of a beneficial ownership uh, in the context of India-Netherlands tax treaty itself. And the observation of the Bombay High Court there was that if a particular jurisdiction has approved a particular entity in a manner that it has approved, then that does play or has a persuasive value while determining its taxability in India as well. That is a very important aspect. If one can prove that the Dutch entity or the Dutch intermediate holding company has passed the substance requirement test within the Netherlands, then the commercial substance requirement test could come handy even while it playing or even while defending the GAAR or the trigger of GAAR provisions in India. The certainty point there could be twofold. One could, obviously, as Bernd and Evgen mentioned, that the tax authorities and the discussions with the tax authorities is a very good practice followed in Netherlands. Also, the GAAR provisions can be vetted or it can be clarified or clarification really can be sought by the authority of advance ruling in India on the trigger or otherwise of the GAAR provisions, particularly for those who are looking for certainty on the transaction. With this, I just request Evgen and Bernd, both or either of you, in terms of what you've mentioned, Evgen, briefly about the the advantages that Netherlands brings, but a point or two, especially with the IP regime or otherwise, and the MLI on how it would play with, what would be the Dutch perspective to it.
Yeah, thanks. I think if you holistically take a step back and look at where the world is and where the world is heading, I think the key advantage is that if there's one thing that if there's one development that is then that is the development that in international tax structuring, tax planning can only be upheld if the business if the legal structures follows the business. And with that I mean that in light of the developments on MLI and the work that is done at OECD level on restricting letterbox companies from benefiting from treaty benefits, it is very important to make sure that whatever structure you set up, that the structure follows your business operations, so that you don't you don't set up structures in countries where you don't have any business presence. And against that background, I think if you look at the Dutch advantage, then the Netherlands, with their open economy and all the points made on the slides, offers an excellent country to set up a new business. It is an attractive place to live. It's not an artificial country; it's a real country. We offer a good labor force, so all the ingredients are there to make the next step for those businesses and those organizations which are considering setting up a structure in Europe. So I think those the ability to which goes hand in hand with also a business operation and a good climate to set up that business organization. I think that is eventually the key advantage that the Netherlands has over other typical holding jurisdictions. Raoul, thanks.
Yes, that's right. Thanks. You make a very good point, Evergen, that your structures follow your business, and I think if that is how it is made, then whatever be the anti-abuse, that should not bother any businessman. Nishant, your take on this, how do you view this?
No, so I completely agree to the way Everjan has put it, and I think from an India perspective, if I was to see, there is also an apprehension that considering that India has amended its treaty with Singapore, Mauritius, Cyprus, is the India-Netherlands treaty in the next one. One would say that, while there is some sort of murmur that we are hearing, that I wouldn't be very specific to say that, it is done and dusted. In fact, we've seen that even the other treaties, before they were modified, it's been a complete host of activities which are required to be carried out. And I don't think it's that simple and easy. At the same time, I would just want to add one more thing, that when you're talking about a structure, and we at Taxand have been assisting a number of our clients in relation to identifying how best to implement a structure, considering the vast network. So not just from the Taxand India perspective or Taxand Netherlands perspective, but rather from any other jurisdiction from where the investment is emanating. Also identifying which is the most effective structure, considering what is the nature of investment. Are you investing as a multinational enterprise and M&E, or are you investing as a sort of PE investment, or are you investing as a fund, which is an investment fund? And how do you structure that? And how do you then consider every source of revenue which is coming through becomes very critical. And therefore, for each source of revenue, the tax implication which is likely to arise, not to forget the final tax implication on the exit, will all need to be taken into consideration. Finally, there is also always, like Rahul mentioned and like Everjan has been mentioned, that there are multiple aspects relating to a substance requirement. It's not just one or two, it's not just one specific aspect. And therefore, which aspect to your business is more attuned and more specific also needs to be taken care of in the structure, or needs to be identified in the structure to ensure that it is foolproof, It is not that it has been created as a structure just for routing the investment, but it meets with the substance requirement both from the NL provisions perspective as well as to defend against the GAAR provisions in the country, in India. And finally, just to touch upon that, in today's time and age, another aspect, especially for investments coming to India, is the certainty aspect that, okay, you have created a structure. You are suggesting the structure. I am investing these funds. Is the structure going to be sustained, and is the government going to be acknowledging that structure? That's where, like Rahul mentioned, the various authorities, the rulings by the authorities become significant. So obtaining an advanced ruling, or like Everjan, you mentioned, getting an APA where it is becoming effective. Those are certain further aspects which become very critical when you are coming to determining a specific structure. So that's from my end. Everjan, anything else? We thank the audience for being patient in listening to our presentation, and we'll be happy to respond to any questions that you may have.
Yeah, and if not now, then we will follow up after this webinar. I already saw some questions coming in, and as Sujita mentioned, we'll get back on these good valid questions on one-on-one. Very good. Nothing to add, and indeed, audience, thanks for having us digitally, and can only look forward to meeting, to further connecting with those who are considering further things on this.
Thank you everyone for joining. Thank you, Berend, Everjan, Nishant, and Rahul. And we promise to get back to you with the responses as soon as possible. I will coordinate with the 4 speakers and we will revert. Thank you.
Thank you.